In the previous video we discussed currencies. When you buy American shares, you use dollars. When you buy European equities, you use euros. You need money to buy anything, even stocks, but the question is, how do you buy money? Again, with money, of course. You can buy euros with pounds, dollars with yens, yens with Australian dollars. You've probably done an FX transaction yourself when you've been to a country that uses a different currency than the one used in your own country. Say, for example, I live in the Eurozone where we use euros as means of payment. If I want to take a trip to the UK, I will have to convert some of my euros into pounds in order to be able to buy anything in the UK. But effectively what I do is that I'm buying pounds and paying with euros. At the same time, though, it's like selling euros for pounds, and that brings us to the dual nature of money. Money is primarily used as means of payment, but at the same time, currencies have an exchange value that is expressed in a different currency. So whenever you buy a currency, at the same time you're selling another. And the price of the currency you're selling is unique for each and every other currency. And that's why we have FX rates. FX rates, or currency pairs, depict the relationship of one currency against a certain other currency at a certain point of time. For each exchange rate, there are a set of two unique currencies. On the left-hand side, there's the base currency, and on the right-hand side is the variable currency. The base currency is always denominated in one single unit of the currency mentioned, while the variable currency is one that fluctuates in value. It's how much of the variable currency you need to buy a single unit of the base currency. When we say, for example, that Euro USD trades at 1.0975, that means that 1 euro buys you 1.0975 US dollars. For example, if I want to take a trip into the US, I would have to exchange my euros into US dollars. If I exchange 1,000 euros into dollars, given that the exchange rate is currently at 1.0975, that would give me 1,097.5 US dollars. Let's say that the following year, Euro USD is at 1.10. Now 1,000 euros buys you 1,100 US dollars. That would be 1,000 euros times 1.10 the exchange rate. With the same amount of euros, I get more US dollars. This means the euro appreciated relatively to the US dollar, or the US dollar depreciated against the euro. The rate, as such, is determined by the main market forces of supply and demand. The aim here is to buy the currency you expect to appreciate relatively to the currency you're selling. That's why we use expressions, the euro appreciated against the dollar or the yen depreciated against the pound. Just saying the euro appreciated in general is still valid and means that the euro appreciated against a wide number of other currencies, yet still has much less value. The euro may behave differently depending on the counterpart currency. Say, for example, it may appreciate against the US dollar, but for other reasons depreciate against the yen at the same time. In the next video, we'll discuss the basics of currency trading.